Hi, good morning, everybody. I'm really thrilled to be in Switzerland. It's one of my favorite destinations. And Switzerland has played a very, very pivotal role in my life ever since I started my career. As you just heard, I was an international investment banker with UBS and Credit Suisse. And I also flew to Zurich for the first time, and that was my first flight abroad. So Swiss is very meaningful and important to me. So today, I'm here to celebrate two things. One is the Swiss mastery of the two biggest obsessions of mankind, money and time. And second is to spread Satoshi's message on decentralization. So let's get back to the Swiss mastery. So as you know, Switzerland is one of the chosen destinations for worldwide asset management industry, for sovereign governments, a lot of ultra net worth individuals, and everything to do with money. And there is a term for it. It is called philarguria, love of money. And the second thing the Swiss are best known for is for timekeeping, and it is their mastery over chronometry or horology, the study of time. So as a natural extension of that, the Swiss are also mastering cryptography, which deals both with money and time. So not surprisingly, Switzerland is fast emerging as a hub of cryptocurrencies. And today, d10e celebrates the gathering of some of the world's renowned innovators in cryptocurrencies. And let's take a look at that. I want to give you first a brief history of cryptocurrencies, going back to the 1970s, when Merkle trees were first invented by Ralph Merkle, and you know about the hashes and how the hashes were formed together to form Merkles, which is a key ingredient of the crypto science as we know today. And then came the Byzantine consensus, which again forms an integral part of the cryptography and the algorithms we know, which provide the backbone for the blockchain technology. And then we had the probabilistic revolution, which in a way means that you cannot ascertain something with 100% certainty, but you can ascertain with astronomically high probability that some event occurred. And this event occurred just on the basis of computer science. So these things formed very vital ingredients of what we know today to be the foundations of cryptocurrencies. And then came DGCash. DGCash, I think, was by David Chaump. And then PayPal. PayPal, of course, was a centralized form of a currency, even though it was digital currency. DGCash solved the problem of money being centralized. So it was the first form of private money. Of course, the banks didn't like it, but it was a successful experiment to privatize money. And the problem it did not solve was that of centralization. So we did not have the protocols for decentralizing money. We had the solution for privatizing money. Now imagine, money has been centralized for centuries. And if you have read lexicons and the very famous iconic books like Adam Smith's Wealth of Nations and stuff, nothing has changed for several centuries. Even banks and financial institutions, the topmost premier institutions, have remained the same decades after decades and even centuries, right? So money and economy is the last thing to be disrupted. And we are still not disrupting it. We are at the very beginning of this new era of the new definition of money. So what we have known in the past historically is some well-meaning representatives or governments got together and decided how much money should be in circulation, which is monetary policy, how much each currency should be valued with respect to other currencies, how much money people are spending, whether it is too little or too much, and how should you regulate the consumption of money or the spending of money, which is fiscal policy, and so on and so forth. So this is the known model of money. And today, we have introduced a disruptive concept of money, which is privatization of money. which has never been heard before. And this was the breakthrough of Bitcoin and blockchain, which was introduced by Satoshi Nakamoto. And with this privatization of money, you can create your own currency, which of course is rattling regulators and governments all over the world, because they can't do monetary policy, they can't do fiscal policy, they can't determine your currency's value. None of these things hold true. All these are mechanisms of control which held in the past. None of those hold true in current cryptocurrency world, okay? Which is why we are the anarchists, and which is why we rattle several traditional thinking regulators, governments, and countries. So that's the brief history of cryptocurrencies. Now I want to give you a brief history of smart contracts. And there are several definitions of smart contracts. One of the preliminary definition of a smart contract is you put together a set of conditional logics, and you leave the performance verification of those logics to a computer or to a machine, which is smart contract. Vitalik Buterin defines smart contract as follows. Smart contract is the pooling together of value into a contract, and the redistribution of that value being determined by a future function, the outcome of that function not being known at this point. So the event happens at a future point in time, and depending on the outcome of that event, the pooled assets or the pooled value gets redistributed to the counterparties according to the contract or according to an algorithm. So the origin of smart contracts comes from the Babylonian times, when people used to record contracts on clay tablets, because we were very primitive, we didn't have access to technology. And of course, smart contracts can just be contracts, that is, any logic that can be translated into arithmetics or a computable logic, and which we can leave to the verification by computers. So if any business agreement or logic can be translated into a smart contract, then imagine all the intermediaries that we know of, the thousands and millions of intermediaries. Of course, there are armies of accountants, lawyers, auditors, investigative agencies, law enforcement officials, and so on. None of those would be required if you can completely trust the computers to auto-execute these smart contracts. But of course, that's not reality, because in reality, we'll always have some dishonest players, something going wrong, even technology going wrong. You need grievance redressal mechanisms, you need dispute resolution mechanisms, you need arbitration, and so on. But luckily, our blockchain technology is maturing, and I'm just coming from the DevCon 3 in Cancun, Mexico, where I heard a presentation even on smart contract arbitration. So decentralized arbitration of smart contracts. So as the ecosystem evolves, we'll have all these kind of mechanisms to support the foundational ideas of smart contracts and converting everything, all the business logic, and even law into a smart contract. Now getting into the presentation. Okay, I can't read it very well. Okay. Sorry? Okay. Okay, to give you a perspective on where we are currently with the crypto economy. So on the very right, we have Bitcoin, which is about probably $50 to $60 billion today, and the entire crypto economy, which is probably $250 billion today. And put that in perspective, you have the entire USD in circulation, which Bitcoin is an alternative to, at a little over $1 trillion. And you have gold, which is over $5 trillion. And to the extreme left, if you come, you see the stock markets, which is capital markets industry, which is around $85 trillion. So now, when we look at cryptocurrencies, we only think of them as currencies, right? Bitcoin is a currency, which is a close substitute to a US dollar, at least for some believers of Bitcoin, right? So if Bitcoin can disrupt USD, so look at the proportion of $50 to $60 billion to $1 trillion, and look at any other cryptocurrencies as technologies to replace real industries, in pharmaceuticals, in shipping and manufacturing and so on, which have nothing to do with blockchain. And if blockchain is applicable to those, or in industries like securities or capital markets, which are all encompassing, $85 trillion, then we are nowhere reaching near potential of what we could possibly achieve, right? So we are really at the cusp of the beginning of this new era, and we should all be lucky to find ourselves at these early stages of a new revolution. So we could all be, really big disruptors tomorrow. So here are some of the big successful ICOs. So of course, the most successful ICOs this year in 2017, some of them raised more than $200 million and so on. But we haven't seen as big a disruption as Ethereum, which happened in 2014. And why is Ethereum such a big success and a disruption? Because it created a platform to mass distribute smart contracts. It created a platform where every single person can create a smart contract for their use and put it on the blockchain. So it's basically like the smartphone, where hundreds and thousands of applications can be made available through an app store. So because it's a foundation layer platform, all the value to be built on blockchain will be built on this platform, which is why Ethereum is the most valuable and the most successful blockchain application so far. So out of all these successful ICOs, we have not seen a potential for such disruption. We're only playing at the edges, at the seams of what is possible. So which is why I want to introduce you to a real-world problem, which is friction in the global capital markets flow. So there is a well-researched problem in the industry which is called an allocation paradox, where countries with the maximum productivity output or the fastest growing economies are not necessarily receiving the highest investment. Okay? And this is because of a lot of heterogeneous factors, which is growth rates of companies, frictions, regulations, artificially kept interest rates, returns on companies like dividends and so on. These are not naturally derived parameters to measure the performance of companies or countries. These are artificially created, and therefore capital flows not according to where it should flow. So the other problem is industries like capital markets are characterized by huge opacity. Now, opacity means the opposite of transparency, right? And blockchain stands for transparency. So wherever there is opacity, it enables the incumbent players, like intermediaries, for example, to unlock a lot of value for themselves, because the participants don't know how the system operates. Right? So the intermediaries, like lawyers, for example, you don't know how to deal with law, so you pay anything the lawyers ask you for at an hourly rate or whatever. And similarly in capital markets, because there are millions of players like brokerage houses, custodians, settlement, clearing, and a lot of other players that you don't understand what they do, and there's a lot of opacity and high fees. And especially when companies go to capital markets to raise capital, at the initial public offering, every single company, no matter how successful it is, including the Googles and the Facebooks, they pay 7 to 10% of fees as proceeds to the investment bank, right? So this is regardless of whatever company, and an institution no less than OECD has lamented that investment banks are engaging in collusion, which is unfair market practice, and therefore you cannot go to another bank and say, hey, bank, offer me lower fees. All of them charge the same fees, so you cannot escape from the banking oligopoly. So what is the solution to this? You have to pay 10% of every single investment dollar that you raise to the investment bank, and they don't necessarily provide much value, at least in the times of blockchain technology. These are the league tables of investment banks, where just the top 10 investment banks get to make $100 billion, and that is only in the income, that is only in the fee income, not even in the interest income, where they have to lend their balance sheet to earn that income. This is fee income, which they make as lead managers or advisors on issues like IPOs and bonds. These are some of the headlines against banks, where OECD and a lot of other market players have publicly come out and said that banks are being antisocial. OK, so here is the solution we offer. So for the first time in history, we have now available to ourselves a technology where anything of value can be exchanged between two parties without necessitating the intermediaries. In technical parlance, this is called trust minimization, or minimization of vulnerability to strangers that are not necessarily trustworthy. So applying this concept of trust minimization to a capital markets platform, if you enable the primary issuance of securities on blockchain, so basically this is extending the ICO model to worldwide securities across every single industry, right? So right now, the ICOs have happened only for blockchain-related applications. So only the companies that have some blockchain application can do an ICO. So if you open this market up, and if you allow companies to offer real securities, real shares and real bonds that represent something in the company rather than a token which represents nothing, and you open it up to real-world economy and real industries, like I said, manufacturing, pharmaceuticals, widget manufacturers, tourism, and so on and so forth, then all of them would benefit from this technology, which is frictionless, which is accessing global investors, which is borderless, and you don't have to pay fees. OK. So that's a definition for those who are interested. And here is technically how the smart contract platform works. And of course, there are several limitations of the blockchain technology today, and the most touted ones being it does not have the privacy, it does not have the throughput, and it does not have the performance characteristics of other centralized institutions like the Visas and the NASDAQs and the PayPals and so on. And that is deliberately by design, because we don't want the centralized institutions' vulnerability. We want much higher security that comes from distributed systems. And we don't necessarily need the nanosecond throughputs, because we are not looking at algorithmic trading or speculative trading and so on. We are trying to solve the problem of issuers, that is, companies issuing securities to investors, to investors directly. And we are solving the problem of investors trying to find investment opportunities worldwide, right? So if you're trying to invest in a company, you don't care whether you get the security in 1 second or whether you get it the next day or in 10 hours or so on. And we have proved this in the case of ICOs, where people have waited for hours and even days, right? So speed is not a problem. And we are not high-speed algorithmic traders, so we really don't care about nanosecond speed. So of course, speed becomes an issue when we open this up to be a secondary exchange for people to trade, that is, buy and sell securities on this platform, which is an alternative to a stock exchange, like alternative to NASDAQ. At that point, the speed becomes an issue. And even then, blockchain technology is now discussing protocols, alternatives, which can match, theoretically at least, the speed of the centralized institutions. So you've heard about the Lightning and the Raiden network, and I heard about Plasma, which Vitalik created only in the past few months. And there are several other alternatives that are not even compatible with Ethereum, right? So there are at least 4 or 5 founding teams which have come up with protocols that claim to have several thousands per second transactions, compared with Bitcoin transactions of 7 to 35 transactions per second, and latency of 14 transactions per second. So the times are really promising, where blockchain can promise you transactions of several thousand transactions per second. That is when we can really think of taking over the centralized institutions and having blockchain penetrate the mainstream finance. Let me dwell a second on this. So here, What you see in between is not an institution. It's just a smart contract platform, which is matching the investors and issuers on both sides. And then there is a fiat to crypto exchange operating to convert your fiat money or your crypto money into your internal digital currency, which then goes on to be used to convert it into securities. So as you can see, this is completely automated. And we are also trying to automate the processes that go on in investment banking to determine the initial issue price. I think, OK, I'll just rush. So basically, this is the next horizon. This is the next stepping stone or the next inflection point in taking trust minimization to financial contracts. So this is a really big deal. We have to come up with a lot of terminology. We have to create a new lexicon for financial smart contracts, which is a very ambitious vision, which is what we're working on. We're trying to create an architecture where you can have P2P trading of loans. You can have an equity crowdfunding platform. You can have an initial stock issuance. And basically, you can have a stock exchange on the blockchain, and there will be no intermediaries. It will be a completely automated platform. So first came the unstoppable cash, which was Bitcoin in 2008. And then came the unstoppable computing, which Ethereum introduced by way of smart contracts in 2014. Now the time is ripe for unstoppable capital, which is when blockchain will benefit every citizen in the world. And it will really put the power of decentralization in the hands of people, because there's no person in the world, no company in the world that does not want to access capital. That's when blockchain will truly go mainstream. So that is the promise and the vision of DGCAMP. And we aim to bring this to market sometime next year, 2018. We are trying to build the platform privately even before doing the ICO. And once we have at least some rudimentary platform, we plan to do the ICO later in 2018. Thank you.